everyone, and good afternoon. Thanks for tuning in to today's Market Color call. Before Jordi shares his thoughts, we would like to share our compliance department's thoughts, which are as follows. Weiss does not recommend particular stocks, bonds, options, derivatives, or securities of any kind. We do not guarantee any results or investment returns based on the information you receive. Although we have used our best efforts to provide the most innovative trading and investment strategies, the views presented today are forward-looking statements which are subject to change as circumstances change, and we cannot promise future profitability. If you have any follow-up questions after listening to the webinar, please feel free to reach out to Jordi or the marketing team. We would love to hear from you. A replay will also be available on our website. Jordi, the floor is yours.
All right, everyone. All right, this one might be a little bit longer. I'm just going to prep you no more than a few minutes, but there's not only a lot of charts, but this one's kind of unique. So I'm going to continue to update on where we are in the market, going through it in a similar fashion. But I really wanted to spend some time on kind of this title I did, which is my thoughts really on inflation and growth versus value. To put this in the context, this is the weekend where normally, for those of you who receive it, I send out about a 10 to 12 page Kentucky Derby write-up, and it kind of fits in with what I'm going to talk about today. My father really taught me how to handicap at a very young age, and the way that it started was not to try and figure out who will win, but to figure out who could win, and then look for value amongst the odds. The reason that's important is because in almost all the conversations I've had since I started doing these webinars, the biggest pushback from people has been around the fact that the economy was going to be weak and that we're in a deflationary situation, and that Amazon, Microsoft, Apple, and Google would be the winners going forward because they were the winners. And really, to me, and going back to my father's analogy, it just hits me that when you're looking at a race program and you look at the horses that have won 10 races in a row, he would say, well, of course they're the favorites. But the question is there value in that? If they're off at even money and you think the next 5 races they're not going to win, or that there's other horses that you think could win, you're better off looking for a horse that might be 50 to 1 and has a, in your opinion, a 5 to 1 shot to win. And that's the approach I'm taking with this. So rather than debate whether inflation is coming, I want you to really think about the part about what the odds are right now and what your views are. Because when you come out of something that is most similar to 2008 or 1987, those are always regime shifts based on history. And so you have to think forward and really look at what's priced in and not priced in. So just to start off, I've had also a bunch of conversations where people have mentioned to me that deleveraging always leads to deflation. And although I can make arguments that that's not always the case, I'd rather do it this way, which is just use this first display, which shows the central bank and fiscal side that's been injected into the system so far. There's more to come, but when you just look at the $18.9 trillion globally, the question I ask is, if the number was 5 trillion, 10 trillion, 20 trillion, the real question is, at what point are we actually leveraging and not deleveraging? There is some point in here where the numbers get so big that that has to be built into the equation, but I very seldom hear anyone come up with a number that really goes through, and that's what this is going to be about. We are injecting a lot of the money to try and stimulate demand, and the real question, and where I will spend time on, is this whole concept of the supply chain. I was going to write a paper at the beginning of the year. It was going to talk about oil going higher. It was going to talk about potential inflation. Obviously, that would have been completely wrong to what's happened so far this year. But the reasons behind it, to me, have actually intensified. The global supply chain has been disrupted for the last 4 years by 4 major events now. It was 3 until this year. But really, it started with the commodity fall in 2015-16, which changed the ability of those companies to borrow money. Most of their yields blew out, the equity went down, the market cap shrunk of the companies. And even though production went higher, there's no doubt that you had a lot of companies producing that were in serious trouble. Then you had ESG, which put pressure on companies and has continued to be there. Most of those are industrial revolution, they're energy, they're materials, pollution-related ones. We had the tariffs begin in 2018, continue into 2019, and they have not come off, which was going to be, those three were going to be the major arguments for what is happening around the globe, which is making the global supply chain more difficult and bringing things more domestically or regional. The final thing which occurred is the pandemic. And now we have a situation where I don't think we know how bad the supply situation will be. But I will just leave it on this. Most of you know I lived in Brazil for a period of time, and I was always interested in talking to people about the hyperinflation days, because it's the only real example of anything in the semi-developed world, or the world of places that survived through it, to hear what went on. We obviously, I'm not calling for anything related to that. This is more of a reflation that could lead to stagflation down the road. But I will see that seeing lines outside, having people hoard stuff, walking into Whole Foods at 3 o'clock in the afternoon and having bare shelves continuously for the last 4 weeks, I think at a minimum, people should at least be recognizing that at an individual level, soon to be at a company level, and definitely more importantly at a country level, we are going to see more and more hoarding if the supply chain is disrupted to the magnitude that I think it could be. So remember, getting back to the racehorse analogy, as I take you through some of these charts, the way that I think about handicapping in a successful manner is to go through and look for patterns, real-time indicators, and then something which is indicative of the odds. So to start off here, I just want to go back to what I had done the last kind of few weeks. This is what the S&P has now done. It's made 62% of the fall back already through yesterday. To put that in perspective and why that's important, going back again to hit the 62% retracement back coming out of 09, we didn't get there until a little bit over 9 months, about 10 months later. So this gets back to the speed. And like I said, assets will discount way before the economy turns. I mentioned before, but we were still having negative job growth here. So there were still more people losing their jobs than getting hired almost a year later. So remember that when we talk about possible inflation, I know there's no inflation right now, but I'm thinking that assets will start discounting this way in advance, and that's the purpose of this webinar if it does come true. Now, in terms of how quickly the demand is coming back here, China is about to release their April auto numbers. I think it's very important. The estimates are for it to come at about 17.5 million SAR, which would put it right here, which means in China, in the 2 months following, they have now made back 62% of their autos. Most estimates have them getting all the way back to the peak or close to it by July. When I go through and look at the US, this chart, I just want to make sure you realize the reason I brought this one up is the 62% retracement. So this is two charts. The white line is the US SAR coming out of 08-09 for auto sales. And then this is the S&P. There's two things about this chart. One is to get back to 62% of the peak in SAR, it took us all the way to the end of 2011 for the white line to get back in there. So it took a long time to get back there. China has now done it in 2 months. The other thing to look is how much the S&P drives auto sales. One thing people should remember about the economy in the US is that 45% of consumer expenditures are a combination of transportation and housing. So when you get through the fact that we are still an industrial economy that needs to have materials for those things and is based on supply chains and wagers and wage earners that are on the construction side, I think when you go through the analysis, we could have issues in terms of the supply side, but the demand side, because of the S&P and because of some of the indications we're seeing on the grand reopenings around the world, in particular China, I think it's worth noting. Again, you guys have seen some of this. This is M2 over the last 7 weeks. You can go back and see this is coming out of, this is after 9/11. This is obviously coming out of 2011 in terms of the debt ceiling crisis. And then this is in 08, going when we started, the Fed started QE effectively. So money supply is growing at a much faster pace in a short amount of time. This is where I'm going to segue into, okay, we are definitely hearing more supply issues. This is the beginning part. This is the easiest one to see right now. This is beef prices over the last 13 days in the US. This is pork belly prices over the last 3 weeks. So similar type time period, you're seeing these numbers, they're obviously coming out and you're getting some inflation already. Some of the shipping rate numbers, you have to remember that we're going to have less stuff going out there in terms of planes and things along those lines and shipping rates. Even this is for oil, even with oil prices collapsing and storage things being everywhere, you still have these shipping rates for things which have gone higher during this time period. And a lot of this has to do with bottlenecks. I'm going to start to go into some of the indicators. So those are some of the patterns, just in terms of things that are going on, and some of the data that is starting to indicate you should at least be paying attention to it. Now I'm going to go some of the things that usually precede a big pickup in reflation. And again, I want you to think about reflation, not inflation. So in the case of reflation, the last month, or this month, was the largest rise for the machinery names in Taiwan. Taiwan has always been an important indicator coming out of recessions. They're obviously linked very closely to China, and their data is traditionally a little bit more easier to understand. You can't really get this kind of data from Hong Kong, so I use Taiwan generally and Korea for indicators. This is the best month for Taiwan since March of 09, which was obviously the lows coming out of Lehman and the beginning of the reflation trade that year. Just taking it further to show the relationship and also to highlight to you other indicators that you can look at that I'm looking to see for inflation. In this case, this is the relative value of the Taiwanese machinery to the Taiwanese market. That's the white line that broke out to new highs for the year. This is the overlay with the Asian currency side. If we're going to get a strong inflation move or reflation, I would expect it to start out of Asia, and the Asian currencies should be going up while the dollar is going down. This is the Taiwanese dollar right now. Relative to that same Taiwan relative, or Taiwan machinery relative to the Taiwan index. This is showing that the currency is even stronger in Taiwan right now and is leading the way. So I would watch the Taiwanese dollar as an indicator. And this is the Taiwanese dollar that is overlaid with cyclicals versus defensives in the US. This is the first chart I'm showing indicating that cyclicals versus defensives in the US, they've bottomed and they've turned higher. I'll spend more time on that going forward, but you can see the relationship that's gone on. So we already have the Taiwanese dollar that's moving higher on this point, and you can see that when this whole move started originally, going into September, June, September of 19, and really this point here is the most important. This is when we started to have the reflation bounce at the end of last year, and that's why I was going to write a paper on inflation coming into the year, reflation at the beginning of the year. Then we had the pandemic. Taiwan dollar has continued to move this direction following what it did in the fourth quarter. Cyclicals versus defenses are lagging, but they have bottomed and have turned higher. This is some more. Now this is just going to go through a bunch of indicators very quickly that I look at to see if there's a breadth or a contagion of data. Over the last month since the lows in the market, we've seen energy outperform technology. That is despite making new lows in crude. We've seen tips break away from crude. So this is the current front month. Obviously, the past front month went negative, so using this is even a little more conservative. This is the June contract. You can see that when crude broke down and took out the lows, tips did not. And so I look for divergences to say that things are different. In that week, tips were actually higher. So the break evens were higher that week. This is, again, the cyclical versus defensive, just on a shorter term basis, showing that it has been trading higher even as deflation fears have continued. This is the Morgan Stanley inflation versus margin squeeze. This is the theme that I think is going to be the most important, is which companies can actually benefit from reflation, which companies will have issues with input costs going higher, margin squeeze. So that's been acting well. This is small cap versus large cap. We obviously have seen this under pressure for quite some time now. This was a big move this week, the prior 3 days. Today's been a little bit mean reversion on that trend, but you've seen small cap start to outperform large caps. If this continues, I would expect that that will continue. So that would be another reflation opportunity if you want to look for things. This is semis over the NASDAQ, which traditionally is a very cyclical reflationary thing. We're getting a down move today back on some US-China relationship fears. This is discretionary versus staples. So despite all the lines for toilet paper and everything that really commenced in a major way right here, March 18th, we've seen the discretionary side outperform. Amazon is a big part of this, so it's not that surprising, but it did fall with it. We've seen the big rip higher here. Now you're getting into the dollar. The dollar has moved lower each day this week, all 4 days. It's been gradual, stubbornly, I would say. It's not moving quickly, but if you're going to have a reflation trade, I would expect that the dollar will move lower, which right now I would say is counter consensus. This is the Asian dollar index. This is the yield curve, which actually did bottom in September. So very similar to the Taiwanese dollar. Taiwanese dollar basically bottomed right in here and started to strengthen versus the dollar. The yield curve has basically continued to be on the slightly steeper side. If we get any kind of reflation with the Fed pegged on the front end, you should see steepening yield curves. So I would continue to focus on yield curves as another indication that the market is getting more interested in inflation. This is the metals market. So this is a broad-based metals curve index. The main thing I want to bring here is crude made a low. This is another divergence. The metals did not make a low. This would be the first place that I would expect to see, since China has already ramped up things. Gas or energy is not driven by China as much as the metals market is. So this would be indicative of China already picking up. We'll watch how this goes, but I think the metals market is an important leading indicator. Euro Swiss is always one of my more popular reflation ones. You can see again during the September period into the end of the year, you just want to see it stop going down, which is what it's done right now. I brought this moving average in because yesterday was the first day we'd closed above the 50-day moving average. Since December, it was one of the longest streaks we've seen since 2001 on that type of persistent chart. This is EEM over the S&P. This is the area right now where we are not seeing it. I would call this the caboose of the reflation trade, and I'm always looking to see which ones are not working. I could have put the bank index in Europe relative to the Euro stocks. That's had a big week. The emerging markets as of right now are not having a big move. I think some of that has to do with the fact that the virus is just getting there, but regardless, you want to see it. Where I do think it would lead would be on the currency side again. So we've had the first kind of bounce week in emerging market currencies, but again, since March 18th in the lows, emerging market currencies are unchanged, which is a good second derivative change. But again, we haven't seen anything there to indicate that this is going. This is sentiment. So as I mentioned at the beginning, I think people are extremely locked into the deflation camp and the stay-at-home investment camp and the MAGA camp in terms of Microsoft, Apple, Google, Amazon. This is just showing the AAII net sentiment numbers. This is looking over it basically over the last 4 or 5 weeks, the average. So we're at very low levels. You can match up. Then when we've been at low levels, this is the cyclicals over defense, the rate of change. Times where we've been here, we've typically seen a reflation rally. This one was 2019 coming out of 18. So with sentiment down here, most people are betting on deflation, and they're without a doubt, I think, sitting in positions that would get hurt if there was reflation, and we're starting to see the reflation trade at least play out in the short term. This is the final part, and this is where I want to get into what actually I think, if there is reflation, what it means to growth versus value, but this is where we get into the odds portion. This is an index I created for Microsoft, Apple, Google, Amazon for the MAGA side. I did this all the way back to 2009. The reason I did it in 2009 was because that was when this whole thing started. We came out of the crisis, and the iPhone came out in 07, and we've been in this, let's say, slow growth, disinflationary world. And the argument I want to make going forward is what happens if we're in a slow growth, higher inflation world, kind of a stagflation world. What would happen to this trade, and what would happen to these companies in kind of the valuation perspective? Is the market priced for it. In a slow growth software-based world, the only thing that people really invested in was this sector and these 4 names. So these are 4 names that are up here, and this thing down here, this ESG, is it's materials, it's energy, and it's industrials. And I just weighted them based on where they were back at the beginning of 0809. So you can see how different these have moved. So the favorite is obviously the one that has won already. This is doing it in terms of market cap. So you can see right now where the market cap is. I took this all the way back to 08. So at 08, the total sum of the MAGA tech group was 660 billion. The total sum of energy, materials, and industrials was 4.1 trillion. And now here we are at another inflection point, in my opinion, and we're at 4.8 trillion. And then the combination of the 3 of these are now 3.7 trillion. So you've got these mega cap tech names that are basically their market cap. Those 4 companies have completely dominated everything that's gone on. And I just want to take it to where now I'm bringing up every single sector in the S&P 1500 relative to that one. So up here is the leader, and then these are all the companies in all the other sectors. The largest number 2 one being the healthcare side. So except for the healthcare index, these 4 companies are greater than all the other market caps of the sectors. And one down here, which is the consumer side, which is 3 trillion, that includes Amazon, which is obviously included in this one. So that would be down at 2 trillion. This is just, again, to show that if you believe that those companies are going to win, you're not alone at this point. They are the favorites in the program. And the question is, if the environment's changing, are they the best place to be? This is where the growth versus value side show. I just want to indicate this is the long side of value relative to the short side of value relative to the S&P and the spread between it, which just shows you how incredibly divergent right now valuations are on names that, again, are sensitive to the tech side versus sensitive to the inflation side or the industrial revolution side. This is the impact. This is value over growth relative to that the ESG index I created, industrials, materials, energy, relative to those 4 companies. So you can see it overlaid with value versus growth since 2016. Remember what I said with the importance of 16, 17, 18, 19. That is when, to me, we attacked the supply side in a major way in the Industrial Revolution. This is pure value, the Bloomberg pure value, again, overlaid with that same ESG relative to MAGA. This is the ESG relative to MAGA overlaid with the S&P value versus growth index. And then this is it overlaid with the MSCI World Index relative to the S&P. So for those of you trying to decide if we get reflation, who would it benefit? I think it would benefit the rest of the world outside of the US for a variety of reasons. This is just showing an indication of kind of matching up where we are here. This was beta, so this is the rolling 30-day move in beta. And beta, the last time we had a move this fast was the beginning of the last reflation effort, which was back in April of 09. That one only lasted 9 months, but I think it's important to be seeing similar patterns at this point in terms of beta, because much of beta right now is junk. In terms of growth versus value, we've had a massive move in growth versus value that really happened at the beginning of this year. The last time we had a similar move on a 30-day rate of change was back again at the lows. This is leading into the lows in February or March of 09. Then we had a subsequent fall. You see the same pattern occurring here right now. I would watch growth versus value, because if we do get a change, there's a lot more room to go on this. This is the pattern of it, quality versus beta coming out of 2008 relative to growth versus value. So you can see quality versus beta goes. You hear a lot of people say that there's a scarcity of growth, so you have to be in the growth names. They said the same thing of quality versus beta. There was a direct overlay with these, and if you go see what's happening today, you had a very similar move up where people were paying for quality balance sheets and growth. The growth versus beta thing has unwound sharply as the central banks came in and helped credit. We've just now started to see the growth versus value, but you can see the massive divergence. So I would watch the growth versus value shift potential at this point. And that's really where I'm going to leave it. So again, I would treat this more as the fact that this is something which very few people think could happen. I think you need to be thinking about where things will be a year from now. And if you think there's a possibility of supply chain disruptions, you want to look for companies that have pricing power and are not going to get dramatically hurt by the input costs. But I do believe that there's a higher than the market believes possibility of the supply chain being an issue. And as the market goes higher, then the market starts to value these sectors which have lost tremendous amounts of money. And there's much more to invest in a reflation world than there was. So I'd be looking at value over growth as an opportunity. I'd be looking at international. And the only sector that I think which will dominate going forward from a growth perspective to me will be the healthcare side. I do believe in this global Manhattan Project type thought process for what's going on with coming out of the pandemic and all the money that's going towards it. But I'll leave it there. If anyone has any questions, as Amanda said, reach out directly to the marketing team. You can also reach out directly to me, and I'm happy to get on the phone and discuss this. I've been doing these discussions and kind of presentations now for a couple weeks, and I appreciate the time.
Thanks, everyone. That concludes the webinar.